All right, Kyle, for our main topic here on the Security Token Show, episode 128,
Nice.
We're talking about BlockFi. BlockFi is a massive crypto company, multi-billion dollar valuation. If you haven't heard of it, let's start there, Kyle. Can you break down BlockFi? Who are they? What do they do?
Sure. Basically, BlockFi is a company based out of Silicon Valley in the VC growth stage of the Bitcoin space. And basically, BlockFi works as a place that you can put your Bitcoin into, right? You have your cryptocurrencies that you can store through BlockFi and get an interest rate on what you deposit in there. So they're basically a custodian that offers, interest rates on your Bitcoin. And this went super viral as they offered free Bitcoin and high percentages of those returns to investors that seemed a little unsustainable for a long time. I remember for a while it was like almost double digits potentially, where you just store your Bitcoin with them and you could get double digit returns in Bitcoin on the assets that you were already holding, which could be a super serious investment and could translate into a ton of dollars as the price rose up.
I think all that interesting, attractive rates came because they raised a ton of venture capital money over the last few years. We're talking about over $500 million. It's actually last year they raised $350 million alone. So you have to imagine that that's going towards trying to grow the business and aggressively expand and get more users. In fact, it might have worked. They have now over 250,000 users, supposedly, a massive base of users. In fact, so big that they've managed to lend out $10 billion supposedly already to date. That's a ton of money all through the crypto ecosystem.
And yeah, so their business model revolves around hypothecation, this idea that they take the money from you and then they can use that float in order to make money in other ways, lending it out to other people, or famously, they were actually buying the difference in price between Grayscale's Bitcoin Trust and the price of Bitcoin, and were able to leverage that arbitrage opportunity to generate a yield, which then built a slightly sustainable project until we saw a kind of a comedy of errors all combined to cause some issues here, right? We saw Grayscale's price actually dip into the negatives. Instead of it was at a premium to the price of Bitcoin, now it is at a discount, which took away that opportunity that they were leveraging. Also, we've seen how these prices, these yields that they were providing as a platform have steadily decreased over time, which, I think a lot of people felt those might not have been necessarily sustainable as the consumer base continued to grow. And that, I think, has also isolated some of their customer base as it's less attractive, right?
For sure.
You're less interested in getting a couple percent on half a Bitcoin as you were to get double digits on unlimited, right? So those restrictions have also caused some interesting things. And then in order to help inspire that, they created these BlockFi interest accounts, BIA, where they were, again, offering really high yielding accounts at super high rates, I think 8-9%, something like that.
Very attractive.
In exchange for stable coins or for Bitcoin and some of these other structures. But I don't think the SEC was too happy about that, were they?
No, they were not, because that started to get into their territory. As many of you who've been watching this show know, there is this little thing called the Howey test. This is what, if you haven't heard of it, the SEC uses, thanks to a legal precedent back in the day, to determine what is a security. A security being an investment contract, something that, of course, is triggered with profits and returns, someone being a middleman to help make those efforts happen, and of course, an investment of some kind, potentially the form of cryptocurrency in this case. So this, of course, set off actually not just the SEC, but even state regulators. Each state has their own little version of the SEC as well, and they did not like the fact that BlockFi was coming into their state and offering this product without registering it with them. And this then set off some more bells, of course, bringing in the SEC. And now recently, we saw a lot of activity, a cease and desist, which is a scary thing for any company working in the crypto space to get from the SEC about their activities, of course, with their accounts. And furthermore, we've recently learned now that they've settled with the SEC for a massive, huge $100 million fine. Kyle, that is a big fine.
Wow. Yeah, no, we were just talking about the settlement that T0 made with the SEC from a couple weeks ago. That was $800,000, right? So we're talking $100 plus times bigger than that coming in this fine. I don't know if I've seen a fine this big in quite a long time, but I don't think it actually confirmed or denied guilt, or did it? I'm not totally sure. A lot of these settlements, they're able to kind of agree on a penalty without actually agreeing that anything was committed. However, a cease and desist was ordered so that they had to change their business operations. This means that they need to comply with, I think it's the Investor Act of 1940 or something along those lines, which essentially is still the guidelines we use for a lot of these regulations. It's from 1933, 1940, which is where some of the conversation and narratives come around how maybe some of this could be updated, now that we're talking 100 years ago. But that's besides the point today. They need to comply or die, essentially, according to the SEC. $100 million, no small fine, but you could look at it from a positive as well, that now they have clarity on where they need to go in order to do this properly. And if they can do those things, they're now able to scale without fear of the SEC.
They sure can. I mean, it's a big fine, and even one of the commissioners did voice the fact that they thought it was maybe disproportionate, but here we are. And it didn't necessarily was designed to crush the company. We know that only half of it needs to be paid up front, and the rest of it is actually going to be paid out over in installments, so that therefore the company actually can continue with its operations. And as you pointed out, Kyle, simply needs to fold into compliance so that they can continue to offer their accounts and their cool services.
And at least they're consistent from the SEC's perspective. We saw how they served Coinbase with a Wells notice, which is essentially a more strict cease and desist that says that if you don't, we actually have a case to sue you, as opposed to cease and desist, which is more like, hey, this is a warning, right? So Gary Gensler came in strong with Coinbase. We talked about how Brian Armstrong, the CEO of Coinbase, was not super excited about that and kind of publicly lashed out around how he felt that was unjust. However, you can see that they're also going after BlockFi, so it is hard to say that they're being, selective on this. They're trying to enforce these rules, which is really where securities laws come into it. And this is the beauty of security tokens, and this is the security token show, so we always like to spin it around into, how this is beneficial for our industry. And when you look at cryptos, you look at NFTs, you look at some of these products, they do everything they can to try to say that they're not relevant for the existing laws and framework, and that they can exist outside of it. Whereas with securities, we can attach real world assets, we can create revenue streams, we can create investment opportunities, real legitimate investment opportunities, and do that in a way that's public and safe for both the investor and the company.
That is absolutely the case here. And of course, we expect a lot of big things from BlockFi. I imagine that they'll probably even raise even more money. Again, they have a massive customer base. At the end of the day, as you said, it's just about following the rules. And in this case, the SEC had to, step up because this is a rather large company at this point. So I think we can expect some more activity out of the SEC for sure against more companies potentially offering similar service. We know there have been some others already under fire for similar products. So this is just us reminding you that this is happening. The SEC is here. If you're exploring issuing these types of products, or you're looking into using them, these are issues that could come up if the company isn't properly aware of what licenses and what needs to be done in order to offer, financial products.
That's absolutely right. And it's going to be interesting to see how some of these other big firms are treated in this space, especially now that we're getting into these more licensed institutions like New York Stock Exchange or DBS that are offering products. It's going to give some of these upstart companies a run for their money, since they don't necessarily have the licenses that some of these bigger, more established institutions do. And we're going to be the first ones here to let you know and keep you updated on everything going on in the space. You can subscribe to our newsletter, What's Drippin'. You can find that out at newsletter.stomarket.com. For more information on that, you can find out news on stomarket.com/news. You can follow us on Twitter, LinkedIn, reach out to us anywhere you want. You can find us. Just search security token on Google, and we're going to be the first 5, 10, 15 results. You better believe it.
We've got some awesome news shows, Spilling the NFT, Open Tab, and a whole lot more coming at you on the YouTube channel for Security Token Market. And for now, that's all we've got for you. Looking forward to catching you next week on Monday. Happy tokenizing.